Hey everyone, today on the final bar, we'll do our normal Friday routine. We'll wrap the week. We'll focus on how the pictures have changed over the last 5 trading days from last Friday to this Friday. We talked about last week into this week being a digestion phase. You have the big meal. Now, this is the stretch where we digest it. The digestion phase turns into something a little more sinister, a little more destructive if we start breaking support levels like the 50-day moving average. We'll look at that in a moment, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts. We focus on the messages that the markets can provide back to us. I've often taught don't use the word should. Should is a four-letter word as an investor. So instead of talking about what the market should do on this show, and when we look at charts, we're talking about what the market is doing. We're talking about trend following, focusing on trend and momentum indicators like breadth and sentiment. You've had quite a rotation this week with some of the breadth indicators like cumulative advanced decline lines turning from sort of bullish to neutral, neutral to negative. Things like the bullish percent index, which have never really turned positive. But also, if we look over at sentiment, yesterday we talked about the AAII survey with the biggest drop in bulls that we've seen in quite some time, the biggest increase in bears and the biggest spread from bulls to bears since before this bull market phase that we're in the middle of. So quite a lot of rotation that we've seen this week as the digestion phase continues. It's all about the key lines in the sand. So we'll look at the S&P 500 and many other charts when we look at the Mindful Investor Live chart list. Before we get to that, though, upcoming schedule on the show, we have some great guests. We had a lot of fun yesterday talking with Frank Capillari from Instinet. Did a really good job describing the overall market environment. Next week on Tuesday, the 21st, Tony Zhang, the chief options strategist at Options Play. On Wednesday, the 22nd, Jay Pettit from Charts Avenue. On Thursday, Katie Stockton from Fairlead Strategies in Connecticut. Then coming up the week after, on the 28th, we have Alessio Ritigliano. Alessio is a cryptocurrency expert at Chaikin Analytics. Two really interesting disciplines to be brought to bear right now on cryptos, which is quite the volatile asset class for sure. Also, just to let you know, coming up tomorrow, all day tomorrow, is the TSAA, the Technical Security Analysts Association, based in San Francisco. It's their annual conference. It is all virtual. It is an online conference, and StockCharts is super proud and happy to sponsor this event for them. Great speakers like Craig Johnson from Piper Sandler, who's been on the show, another frequent guest, Ari Wald from Oppenheimer, also trading psychologist Brett Steenbacher, a technical analyst, Chris Kimball from Kimball Charting Solutions. A lot of really good speakers. Should be a fantastic event. Go to tsaasf.org for more information on that great event. Let's continue on with today's Wrap the Week segment. This is really the goal of our show on Friday. Two things: wrapping the week and then focusing on your questions. We'll start with a poll, and we asked you recently on our Stock Charts live stream page and also on social media, how important is the presidential cycle in your analytical process? And if you're not familiar, the presidential cycle is the traditional 4-year cycle in the equity markets, where in the first term, the first year of a presidential term tends to be one of the weaker years. I think it's the weakest of the four because a new president just coming in really doesn't have to get reelected for a little while, so they can start making changes and things that may not be necessarily market or business friendly because they have time to make it better. Midterms tend to be a little better because people are trying to get elected 2 years in. Couple years out, that third year especially is when you start to see the market doing well because they tend to do more pro-market decisions to make everyone nice and excited and feeling great about reelecting them the next year. 50% of people said not very important. 39% said somewhat important. 8% said very important. For the 3% that did not know what it is, hopefully you now know. Many of you obviously not paying as much attention to it, and that's okay. This is one of those things that it's not important until it is. And I would remind you, if you've not paid attention to that 4-year cycle, just like recently we're seeing sort of this monthly cycle in stocks where the market's tending to bottom out about once every 4 weeks, just in line with options expiration. That is just one of many, many cycles which tend to proliferate. Check it out. Go to our chart school pages where we talk about the presidential or the 4 year cycle. Worth taking a look at. Briefly, let's talk about what's happening today in the markets, and then we'll go to the wrap the week chart where we focus on the asset classes over the last 5 trading days. We will finish off looking at the Mindful Investor Live chart list. So distribution back in phase today. Yesterday, we sort of had that V-shaped day where we rallied really into the afternoon session. Today was really about distribution. We sold off through much of the course of the day, stabilized going into the close, but overall the damage had really been done with the S&P closing down about 0.9%, closing just above 4430. The NASDAQ composite about in line, the NASDAQ 100, sort of the larger mega cap names within the NASDAQ down a little bit further, but all within that same sort of 1% down range. The mid cap index down a little less, very noticeably. The small cap index actually finished in the green, which is pretty unusual that you have the equity, the large caps down so much relative to small caps, which are actually positive. So quite an interesting reversal. You see financials, one of the better sectors. It's a little more well represented in the small cap index. I could be a part of it. The VIX well above 20 now, actually closing above 21, up a great deal from where it was, a couple points from where it was yesterday. Interest rates going higher today. Yesterday, the 10-year yield settled in around 133. Today, it finished today around 137 after going a little higher in the morning. So this higher rate environment, bonds selling off, shows you it's not at this point showing a broad rotation away from stocks into bonds. It's sort of a rotation out of everything and going somewhere else, but it's not going necessarily into bonds as prices coming down, the TLT down about 0.5%. The dollar index was up about 1/3%. The UUP still around 25. So really it's been choppy sideways for quite a while. Gold was essentially a choppy day here. Really didn't move materially to the downside, although silver did follow through to the downside around 2.5%. Energy prices, okay. Energy was sort of mid-range of the 11 S&P sectors, and the USO was down about 0.75%. Cryptocurrencies actually continuing their decline, depending on where you're looking. Ethereum was actually down 4.5% since yesterday at this time. Bitcoin down about 0.75%. Actually bounced up in the last couple hours or so to move a little bit stronger, but overall lower than where it was yesterday. We're going to get to the chart of the S&P 500 here in just a little while. So I actually wanted to rotate and go to our wrap the week chart. Every Friday, what we do is we like to wrap the week, and this is focusing on how the markets have evolved from last Friday to this Friday. We're going to start with this chart here. Perfect. And we're going to make sure we're bringing in 5 trading days because we did not have a holiday this week. Here we go. So the S&P 500, just to orient you on the chart, the colors will tell you what we're looking at. Follow along with my mouse, and you can see what's what through the course of the 5 trading days. Starting the clock last Friday, the S&P finished the week down 0.6%. It was positive through yesterday's close, so the deterioration really happened in the last couple days and turned into a negative week as of today. A couple things underperformed stocks or large cap stocks this week. This is the NASDAQ 100, the Qs, just a little bit further down, 0.7% this week. Here in gold is the gold GLD down 2%. Just a little bit above that, and then underperforming that, emerging markets down 2.1%, we'll call it. So gold and emerging markets really the worst performers of these major asset class ETFs that we're following. Everything else outperformed the market and actually was in the positive for the week. In purple, we have the Russell 2000, so the small cap index up about 1/3% for the week. Here we have bond prices actually finished up 0.5%. In green, we have the US dollar using the UUP as a proxy for that, up 0.6%. And in brown, we have crude oil up 3.1%. If we add Bitcoin in the mix, you can see that here in blue. I usually show it just at the end because it's a bit of an outlier, up 5.5%. So it's interesting that Bitcoin has bounced up so much. So even in a stretch when Bitcoin prices are arguably going lower, you still have it outperforming and underperforming, the bulk of the other asset classes week in week. Most of the time, Bitcoin is the outlier on one side or the other, and it just shows you the relative volatility that you have in a lot of cryptocurrencies versus some of the traditional asset classes you may be familiar with. So we netted out to a negative week. What are the key indicators of price, breadth, and sentiment? What can they tell us about the overall market environment? As a reminder, we're using the Mindful Investor Live chart list. This is a live chart list that I maintain on StockCharts. You are all welcome to access it. If you've not seen it before, it's no problem. Go to the articles tab, go to my page, which is called the Mindful Investor. There's a gray button at the top of that page that says live chart list. That'll get you right to this point. You're welcome to save, share, do whatever you want with those charts. They are there for your pleasure. So first off, this is the market trend model, and it has three parts of this. This is all using weekly data, and this is one of the models I just kind of have running in the background, a basic trend following mechanism to help make sure I'm oriented in the proper long-term, medium-term, short-term trends. The long-term model turned positive for me back in June. This is a couple months after the March 2020 low. It has remained very bullish through that entire period, and it's really not meant to give many sell signals in a secular bull market. The market would have to retrace quite a bit before that would register. So remains very appropriately bullish here. The medium term model for me is essentially the weekly MACD, or the weekly PPO is actually what I'm using. That turned negative here in May and has remained negative this whole time. I've really spent a lot of time in last month or two focusing on this model. And I've toyed with the idea of changing it and looking at something else that would more respect the fact that the medium term price trend arguably has been just fine during this period. But what it's told me is basically the deterioration under the hood. The fact that the trends have slowed to the fact that the PPO gives a sell signal and remains negative shows you that there's a deterioration in the trend. And I think that's been reflected on a lot of individual charts. If we look at the chart of Caterpillar or something like that, some of the industrials or materials, Vale, VALE is a good example. You see how these have really come off quite a bit, even though the indexes have gone up. So the medium term model being negative has helped me focus on some of that risk potential and make sure that you're managing stops appropriately. And for that, it's been pretty helpful. The short term model actually turned negative in the last week and has remained negative today with the price being below the 5 week exponential moving average. So two of the three. In a negative trend, this is what a corrective pattern would look like. The medium term and short term negative, the long term still positive. And again, the price could deteriorate quite a bit from there and still remain the same configuration. The daily chart of the S&P, if you missed my conversation yesterday with Frank Capillari, it was really well done. He really knows the markets and knows the technical toolkit very, very well. We had a great discussion about this chart, among others. So if you missed it, I mean, we're really talking about the importance of the 50-day moving average, and it's sort of a mixed blessing. I'm super thankful that we have a very clear, very obvious, tried and true way of tracking this trend. The S&P, it's easy in 2021. You wait for the S&P to hit the 50-day moving average. Ideally, we close below it, because every time that's happened, the immediate next trading day, we've gone back and closed back above it. That's happened a number of times through the course of the year, and most months, with one exception in April, we've literally pulled back at or near the 50-day moving average before making new price highs. So that is a very consistent pattern that seems very clear and clear cut and straightforward and obvious to follow. So the challenge, though, the mixed blessing part of it is, because it's so obvious, because it's so clear, what happens when that doesn't play out? What happens when we close below the 50-day moving average and we don't bounce? What happens when we continue to deteriorate and push below the 50-day moving average? So many of my peers in the industry, I think so many investors are focused on that 50-day moving average, which is great until it stops working. Then you could potentially see a flood to the exits as everyone realizes support is no longer holding, as people realize that the buy on the dip crowd is no longer there because they've all bought in and there's no one left to push the price higher. When there's an absence of demand, price tends to go lower, and that's out to more of a negative. So if that would happen, I think the next thing you look at is this first red horizontal line that's around 43.60. That's the most recent swing low from August. As we've talked about, right? Charles Dow's basic tenet of trend following: an uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. This market makes a lower low, and that starts to tell you that there's a potential change of character, and you need to get a little more defensively minded in terms of your positioning and definitely your thinking in the markets. Looking at the cumulative advanced decline lines, we'll do a couple indicators on breadth, and it's been mixed. I would argue. There are times when the breadth picture has looked just fine. There have been times in the last 6 months when the breadth picture has looked downright negative. And I think right now we're in the process of rotating over the last week or two from a fairly constructive breadth reading to more of a destructive. And at best, it was mixed, but it's starting to be more mixed to negative. One thing that has not been negative has been the advanced decline line on the S&P 500, and it just shows you the consistent leadership in large and mega caps. There have been enough large cap stocks that are working to keep propelling this index higher, and the advanced decline line has remained very positive. If you look at the mid cap advanced decline line, I have that very subjectively color coded green as well. Overall, it's holding up just fine. The small cap 80 line, this is not, by the way, updated yet through today's close. That we'll have to update those over the weekend and see if these break down their swing lows. But the small cap 80 line, I'm considering negative. The common stock NYSE advanced decline line, I'm coloring neutral. So overall, these have gone from fairly positive to now sort of mixed, some positive, some negative, and some in the middle. And I think continuing to watch that into next week. If we would see a further deterioration, that is one chart where you would definitely see it reflected. Couple other quick things. John Murphy, the an emeritus technical analyst and one whose work many of us have followed our entire career, literally taught us how to analyze charts, published a note this week to our members talking about the deterioration in the percent of stocks above their 200-day moving average. This was at almost 100% in April. It is down to 74%, which means about 25% or so of the S&P 500 members have managed to break their 200-day moving average in the last 6 months. That is not what a sustained bull market phase should look like. That is more about a bullish phase that is starting to unwind and you're starting to show some deterioration. Finally, the bullish percent index has never broken back above 70. So this is a breadth indicator that turned negative and never turned back positive. It's now just below 60%, which means 40% of S&P names are in a bear signal using the point and figure charts. That causes me a bit of concern. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the charts together and analyze these trends and momentum patterns as we go. A couple quick announcements before we get to our Final Bar mailbag segment. First off, we love to hear from you. Our mailbag that I'll share with you here in a moment are all questions we received from you in the last couple days. We love to get questions on technical analysis, technical indicators, particular charts or ratios that you're looking at, market history, behavioral finance, whatever it is, we'll do our best to point you in the right direction. You can get your email or get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just go to the Stock Charts channel, put a comment below the video that you're watching. We would love to hear your questions. We'll hope to answer one of yours in our next mailbag segment on Tuesday's show of next week. Also, go to stockchartstv.com, use your email address. You can set up a free account, start watching all of our great content from your mobile devices. Also, our website, great special events like the pitch, our mid-year market outlook, our year in review, and so much more. Go to stockchartstv.com or on your mobile devices, just go to any of the app stores, search for Stock Charts TV on demand. Let us together open the Final Bar mailbag. These are all questions we've received from you recently, and let's get right to it. Our first question is this. Why do you compare silver to the index $SPX and AMX, the stock, a telecom name, to the ETF SPY? Is there a rule of thumb regarding relative strength comparisons? So, really good question. And the chart that I'm showing you here is the SLV relative to the $SPX. So, does it matter? To be honest with you, not a ton. And what I learned when I learned relative strength, and again, before I went up to Fidelity, I used relative strength some. When I spent time with institutional investors trying to outperform the S&P 500, I learned to look at it on every single chart I did because that was essentially how we were evaluated. That was the game, was identifying stocks that were outperform or were able to outperform. So the ratio is most important, and the direction of this line is what's most important. It is a simple ratio. So when it goes higher, that tells you that is outperforming the denominator. When it goes down, the numerator's underperforming the denominator. So whether you put $SPX or SPY, it doesn't really matter. The difference is this. The SPX on our platform does not include the impact of dividends. It's not a total return index. It's just looking at the price. SPY actually incorporates the dividends when you do this ratio. So when you have this calculation minus 1659, it's whether or not you include the dividends. The direction of the trend is essentially going to be almost identical. So I don't think it matters a ton, to be honest. I wouldn't worry too much about it, but I've got in the habit of anything that is quoted on price and doesn't have a dividend. I tend to do it relative to dollar sign SPX. Anything that's like a stock or an ETF that potentially does have an ETF, a dividend, and I want to think about the total return impact, I would look at it relative to SPY. Grayson Rose, whose work you probably have seen, he always does versus VTI because that's a broader equity index. It really doesn't matter, to be honest, in my opinion, which one you use. I would use a broad equity index and look at the direction of the ratio. That's what's most important. Next question. When I look at the AAII survey, it seems to me that corrections don't immediately follow a highly bullish reading in the indicator. Instead, it seems the indicator often peaks and then drops before a correction begins. Am I missing something? I don't think so. I actually think you have a great take there, and I took that from a larger question that you sent in. Implying that you read some commentators that talk about extremes, and I will tell you, yeah, there are two ways you can use an indicator like this. One is the very simplistic or maybe overly simplistic contrary opinion, meaning if there are way too many bulls relative to what there normally is, and then that means there's a euphoric sentiment. Too many people are bullish. Anecdotally, everyone's bought, and the market's not going to do anything but go lower. Now, if you look, that's not really been the way that the market has played out here, right? The most bullish we've seen has been 2 days in the last year. One was here in early November of last year, which was before a significant run up in price, or in early April, which again was before this continued uptrend. The second way is what you're more implying, and I think honestly, I think that's what the data tends to support a little more. If you look, the spikes in euphoric sentiment usually happen at the beginning of the end. The divergence when you see the market going higher and there are less and less bulls on every upswing, that's what tells me to be a bit concerned. So the trend higher in stocks on lower sentiment is much more interesting to me than the fact that that the bulls are not to euphoric levels. Having said that, I mean, I think that when there's a good stretch of time where you just don't get a lot of signal from the survey, where it's sort of middle of the road, sort of 30 to 40% bulls, and that's kind of average. That's what in a secular bull market, that's kind of average to what you would expect. And at that point, I think the AAII survey for me is one of those things that a lot of times it doesn't really give necessarily a clear signal. The extremes, the divergences are what to look for. So I think there's a lot of wisdom in the way you ask that question. And I think focusing on the weight of the evidence is a really good way to think about surveys like that. The next question, I was wondering if there's a way to build a scan that uses the Chaikin Analytics Power Gauge plugin or any of the advanced indicators. That's such an awesome question, and I really, really appreciate it. I know I've really been excited to have the Chaikin Analytics capabilities on our platform. It's part of the ACP plugin, or ACP platform. We have a bunch of premium plugins that we've partnered with third parties to bring on. And to be honest with you, even if you never use it, the core StockCharts ACP. It's a really well-designed platform with a lot more to come. I think there's a lot of good ways we will continue to grow this, and I hope you find that it's worth using as often as you need. But we do have some additional plugins for those that want to incorporate some third-party perspectives. If you followed Mark Chaikin's work, he's really, really a sharp analyst and strategist. Has done a great job with Chaikin Analytics, and we have their Power Gauge embedded into ACP as a premium plugin. You can find more information if you hit the little plug in ACP, but basically allows you to bring up a ticker and look at the different components of their model. So you asked particularly on how we can screen for it, and the short answer is no. We really don't have a way yet to screen on things like the Chaikin Power Gauge, to look at some of the other premium indicators, some of our own advanced indicators that we've added onto the platform. The reason why I'm bringing that up is because we are certainly looking at that. Our scanning engine is very, very powerful, and it could be even better. And we've talked a lot philosophically about what that scanning engine needs to look like. We've started to sketch out some ideas there. And the reason why I'm bringing it up and answering your question is to invite all of you. If there are things that you would like to see our scan engine do and you're not able to do it, I would love to hear from you. Particularly, send it to our help desk. If you go to the support desk, we literally quantify how many requests we get for different features, and that's what we will use to determine what actually gets added to our scanning engine. So please, if there's something that speaks to you that you'd like to be able to scan on that you've not been able to figure out yet, ping our support desk just on the main StockCharts page. Go to the little help button in the upper right. You can access our support desk to do that. Last question, and then we're going to have to wrap up. What is the Hindenburg Omen? Really good question, and this is a meaty one. I'm going to give you the mini version, and then someday when we have a lot more time, I'll give the deeper version, or maybe record a special event on this at some point. The Hindenburg Omen, it basically the outlook or the outcome of this indicator is as ominous as it sounds. It's very reasonably named after the Hindenburg, the dirigible that went down, because it basically talks about it recognizes when market conditions are similar to market tops. Now, with a lot of indicators like this, people joke that it called 10 of the last three corrections, meaning it gives a lot of false negative, right? False positives. It gives you the sell signal, but not always does it turn into something negative. We have an indicator that actually tracks the three components of this. It's exclamation point BINYHOD. You can see it on my screen here. And basically, if you add that, it tracks the three components. If it's at zero, they're all not negative. If it goes to three, they are all triggering. And what you look for is a cluster of those negative signals. Use a couple different things. They're all sort of breadth related. One is the Dow has to be above its 10-week moving average, and I should have looked this up before I'm answering the question. You're testing my Hindenburg Omen knowledge. That's one of them. The other two is you need an expansion in both new highs and new lows, representing some indecision. The McClellan oscillator needs to turn negative, and I think that's it. But I might be wrong. If you go to our chart school page and search for Hindenburg Omen, you'll get a detailed article that explains the history of that, created by Jim Mieka a number of years ago. And there are a bunch of variations of this that people track, but this is the easiest way that I've followed it. We did get one Hindenburg Omen signal there in mid-August, but not a cluster. You really did get a negative signal. So at this point, it's still signaling that things are okay. That is it for our mailbag. Great questions, and thank you all so much for asking those very thoughtful questions. Keep them coming. We'll do another mailbag segment on Tuesday's show, but we need to wrap today's show. Go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is the S&P breadth by cap tiers. This is one of the key charts in our chart list, the Mindful Investor Live chart list. Again, I'd encourage you to check that out and follow it. Always some great charts to help you thinking about the market conditions. This has turned a little bit in the last week or two. I had just started to rotate these indicators more positive, and they're very subjectively color coded like a stoplight based on how I think these are all supporting price behavior. I now have it mixed. Some of these are positive. Like I think the S&P advanced decline line is still making higher highs and higher lows above the 50-day moving average. That's all good. The small cap AD line is below its recent swing low and below the 50-day moving average, and is overall very negative. The others are mixed. So I think watching this, if we do get a further breakdown of the 50-day moving average, I think this would be a really important chart to watch to see if you see further deterioration in breadth. And one way that I would sort of validate a corrective price move in stocks and in the major averages would be these AD lines continuing to break down, started to break down through their swing lows in July and August. You will see me color code those from green to amber and amber to red. You will hear me make noise as they rotate, if and when they rotate lower, because that's something that has not happened in quite a while. Chart number two is Caterpillar, and it's not meant to necessarily highlight this particular stock, but more to highlight breakdowns in some of the cyclical sectors. Some of the worst stocks in my screening earlier this week were healthcare, which had a lot of breakdowns, materials and steel names and others, and also in industrials like Caterpillar. This is a stock just today that's attempting to undercut its low from July. It's now broken down through the 50-day moving average, broken down through the 200-day moving average for the first time since back here in July of last year. Now continuing to follow through to the downside, making a new closing low for the last 6 months, but really testing this low from July. If we would break down there, the next low would be around 184. The next potential support around 184 around these January lows, and that's where I might look for further support. But the fact that the relative strength is in a downtrend, the price is in a downtrend, tells you that the cyclical sectors are certainly in a position of weakness. Now, where are we potentially seeing opportunistic movements? There are plenty of stocks that are breaking out, like solar stocks come to mind. FSLR is one that's rotated to the positive side. Home builders are actually one of the better groups today, actually finished in the positive while the indexes overall were down. And on a down day, when you see most things closing down on a day, most of the FANG names, if not all of them, closed in the red today. What actually worked? What actually bounced higher on a day when the markets were lower? And home construction were one of them. Toll Brothers is a good example of that. Now it's potentially making a head and shoulders bottom. That would be a low surrounded by two higher lows. Arguably, I've highlighted those there. If we connect the neckline next week, you'd want to see if we can break above that 65 level. That could indicate an all clear sign, and a break above the May high would signal an all clear. But I would focus on groups that are working. Folks, that is our show for today and a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close for our show. For StockCharts.com in a rainy Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.